Well, the property millionaires and billionaires of South Africa are typically the unassuming type, quietly making their fortunes in an industry that is still the best performing despite market volatility. So could investing in the property sector be your key to financial freedom? In its cover story this week, Finweek looks at how you can become a property mogul. Joining us now, we've got Keillen Ndlovu Head of Property Funds at Stanlib, Jonathan Davies, Joint Area Manager for Pam Golding Properties Hyde Park Office. Thanks for joining us today. So, Mark, I'll just start off with you. I mean, who doesn't want to become a property mogul, of course, but there are various ways that you can look at doing it.
Sure. So basically, I kicked off the story taking a look at this two different strategies. So as I was growing up, my dad always told me the amount that he needed to retire was 7 million rand. And obviously he now gets into his late 50s, early 60s. He's hopefully made it that far. And then I met a mate about 3 or 4 weeks ago, and he was based talking to me about how at 33 he's managed to acquire 7 million rands worth of property. And obviously what he's done there, he's been able to gear himself up. He's got 6 properties plus his primary residence, and he's able to rent these out and obviously generate an income. But one of the things that's interesting about that is he's used obviously other people's money to gear himself to get to that point. He is, however, dependent on the rental income coming in, interest rates staying where they are, and of course his salary to be able to maintain his cash flow. So it's one of these interesting trade-offs in strategy. And for the last 10 years, or maybe even 15 years, you could argue, it's been a very easy situation for residential property. You've been able to make a lot of money quite quickly. Things changed over 2008, 2009. Banks started changing lending criteria. You don't get 110% bonds anymore. The actual growth in terms of property prices, either residential or commercial, are far more muted than they have been. And ultimately, I argue that maybe one of the better ways to get into property is to use something like listed property and take advantage of the consistent dividend yields there and sort of build up your portfolio, because I think that the barriers to entry for getting into property have become quite high for your average 30-year-old.
So there we go, that's the case that you're making today. So we'll argue which is the best way to do it. But Keillen, you're coming in from, of course, the listed property perspective today. Total returns last year, 35.6% relative to equities at 26.7%. And then you've got this year a little bit more muted so far to the end of June, almost 9% return. So what's driving listed property right now? What would you say are the key themes driving returns in this space?
So the key thing is income, growing income streams. On average, we're looking at the listed companies growing their income by about 7%. It's a lot lower than the good times of 2007, 2008, but 7% is still a fairly decent number. And the income is fairly predictable. There's no probably other asset class that can give you a stable and growing income. So property is all about income. Capital is a bonus, comes over time.
How predictable is the income? And I always find it fascinating to go through the listed property financial reports, and they kind of break the tenants down into the A, B, and C category. And then obviously when these guys when their various contracts are expiring, I mean, how predictable have we had instances where what you thought was predictable income actually doesn't materialize? I mean, can you think of examples in recent years?
Not really, because most of the leases are locked in for 3 to 4 years. And they escalate. You've got annual escalations on average of about 8%. So 80% of the leases locked in for 3 to 4 years. So the risk only lies with the 20%. And out of that 20%, yes, you might find 1 or 2 or 3 big leases coming in at lower rents, but on average, you're still getting a nice, decent growth.
When you're looking at a listed property company right now, are you predominantly looking at sectors first and then you go into all other issues in terms of exposure? I mean, how important is it to know whether it's residential, commercial, office space?
No, it's quite important. There's different cycles at this stage.
And what cycle are we in at the moment in those various sectors?
We like the industrial sector. We believe it's stronger than most other sectors. Vacancies are lower, around about 4.4%. And our second best sector will be the retail sector. But then you have to be careful with retail, so it's mostly dominant and big shopping centers. And with the face of actually competition coming through, there's lots of developments coming up, so you have to be in the most defensive centers. Whereas the office market is our least favorite, lots of vacancies. Vacancies are increasing, they're around about 11% at this stage. But then we've got new developments coming through. If you look right around here, there's offices here in Zenton, there's lots of new developments. And the average vacancies for new developments are about 50%. So it means there's lots of choice in the office market.
So there we go. Stay away potentially from too much office exposure. Let's look at buying a hardcore property right now, that asset, getting into it. Of course, I suppose the adage buy low, sell high also works when you're talking about actually buying property. Is this the right time to be buying?
I think it is, yes. If you look at the journey property's taken over the last probably 5 years, I mean, we went through the boom of 2003. 2006, 7, people were buying properties and the gearing was phenomenal. You had banks who would lend you 100% of the money, plus your transfer duty and any other ancillary costs. So it was very easy to get in. And obviously, since the recession, we've moved into a much more tricky market where I think the South African buying public has had to learn a different route. So you have to have your own equity. A deposit is a necessity, and I see this as a good thing. You need to have a vested interest in your property. So to answer the question, is now a good time? I think yes, it is. We've been through a correction phase where prices have dropped. I'm not saying there are bargains out there, but there is a greater access to better priced properties. And again, it depends on what sort of property you're purchasing. You've still got your acquisition costs, your transfer duties to consider. So my advice to anybody considering that market would be to take your time, do your homework, look very carefully at your future growth and the prospects in that property.
Maybe a question I want to throw out there, and it's I try and work out, because we were just chatting a little bit off air about the cost of financing and the concern around interest rates that are coming up, and I guess it applies to both investment formats. But if we just start with residential property at the moment, I was at this development on Sunday and I noticed guys are quite happy to go and approach it with a buy-to-let perspective, but everybody there is putting down a minimum deposit. Interest rates are low at the moment. What happens if interest rates start rising? What's the impact on residential property?
Well, it has an immediate effect, particularly, and we saw it in days gone by, where investors would pick up 3 or 4 units or 3 or 4 properties. They were quite heavily geared, and it's absolutely fine when interest rates are low. But once they start to move upwards, you obviously get put under pressure as an investor. And in some cases, you get forced into actually offloading those investments.
How quickly does a retail property feel that, though? I mean, as a retail investor, I mean, because if
depends, I suppose, how much debt you have.
Sure, but I mean, if your interest rate has moved, how quickly do you start seeing it in the market? If 1%, when does it take 6 months for that to start coming through?
It's almost immediate. So it depends also on the investor. There's some investors who have access to other funding, and perhaps have a hedge or a buffer against that sort of movement. Others who really are stretching their limits initially would feel it almost instantly.
And then if we move it back to the listed property, I mean, the way I understand it, often listed property tends to preempt these moves in terms of, the sector comes under pressure the moment there's expectation that interest rates are going to rise.
Sure.
So how does it, let's assume that, let's say 2014 interest rates are up by 1%, let's pick a number and say 1%, what's the impact on listed property in South Africa?
So we've seen that happen recently in May and June, when we've seen bond yields move up, like the 10-year bond yield, from about 6% to close to 8%. Over that period, we saw listed property lose 19% in capital values. So the market reacts more to the bond market rather than the interest rates. So the bond market preempts that, as you say that. And the relationship with the bond market is about 80%. So you have to watch out for the bond market.
Does that necessarily mean that the underlying companies right now are coming under pressure almost immediately, as you see South African government bonds trading at lower values? I mean, the underlying value in terms of the properties, are they still healthy? Did that 20% or 90% loss in value, was that warranted?
No. So actually what you find is actually the market just prices that short-term pricing versus bond market. So prices have changed, but the fundamentals haven't changed at all. Actually, income growth assumptions are still the same. Our vacancies haven't changed materially. So we're still comfortable with the fundamental outlook of the listed property market. So just short-term kind of pricing versus bond market. Whereas long-term, we're actually pricing in higher bond yields as a house. And we're looking at total returns of around about 11-12% over 4 years, whereas in the last 10 years, property achieved 26% annualized returns. Sure.
One thing that worries me is cost, and the cost of property, and there I'm specifically referring to electricity and rates. And again, it's probably a question that you both have some kind of view on, but if I throw it maybe from the residential property perspective first, reality is rates are rising, probably double digits. There are electricity costs, there is water infrastructure is failing. It's becoming very, very expensive to run an ordinary household, let alone multiple investment properties. Where do you guys, what impact do you think that's going to have on prices in the next 2 to 3 years?
I think it's going to put pressure on prices, and obviously it's a concern to any investor. Besides the fact that you've got your acquisition costs, transfer duty, you've also got your disposal costs. You need to pay an agency unless you sell it privately. So all of those factors need to be taken into account when you look at your return on investment. And unfortunately, it'd be a lot better if they're coming down, put it that way.
You talked about right-sizing the size of your mortgage, and interesting that your boss, Andrew Golding, basically saying that you shouldn't have a mortgage more than 50% because you have to keep check of all the costs that go into maintaining a property. Geyser bursts, garage doors need replacement, whatever they may be, and of course there are cost escalation. So when it comes to mortgages right now, I mean, do you see that property owners are looking for those smaller mortgage, or people are still looking for max amount of debt?
I think we're in a phase of change. So there's the historical culture of maximizing the amount you can borrow from an institution versus a new culture where people are realizing that you do have to have a certain amount of liquidity. And like I said earlier, I think it's a very good idea to have some of your own money invested in the property. It creates a responsibility to that investment. Whereas in the past you could hand your keys in at the bank and go off to Australia. Now you can't. You've actually got to step up to the plate and control your...
But I mean, that's my argument for going for listed property. A lot of people don't have the cash resources to be able to put down 50% deposit. The cost of financing most second properties is too high. So yes, you lose out on the gearing, but you get real growth and you get income from it immediately, and you get liquidity. Do you buy that argument from, if somebody said to you, here's a residential property, second property, take it or leave it, versus listed property? I mean, where do you stand on it?
Let's talk about accessibility. It's easy to access listed property. On average, unit trust debit orders are 500 Rand per month, or like 5,000 Rand lump sum.
Yep.
And the most important thing is liquidity, is exit point. It's easy to exit. Within a week, you've got your cash. Obviously, you're losing out on gearing, but you are getting stable and growing income.
But then again, I mean, okay, that's the argument. You can't live in your listed property, and of course you can't benefit from it in that way. And that, of course, is where the whole argument for actually owning property as opposed to paying rent comes in. So what's the thought process right now? What trends are you seeing when it comes to people deciding whether to own or rent?
Well, there are a couple of scenarios unfolding. With interest rates coming down, people have greater access to finance. So we did see a move where people started to purchase their own properties. In higher inflationary scenarios, it becomes very costly. So people sometimes were forced to opt for the rental option. But now that interest rates have come down, they can actually afford bonds. So we're seeing the lower end respond in that way. And oddly enough, and quite interestingly, the top end has responded well as well. So we might be seeing the first signs of a recovery, at least I'm hoping.
So people are right now taking on a little bit more debt, more appetite for debt, even though we're talking about, from a macro perspective, concerns around the slowdown in the economy.
I think it's linked to sentiment. And if interest rates, I remember when interest rates went from 25% to 23%, everybody rushed out and bought property. They're now sitting incredibly low in relation to that, and there's a sentiment that it's as low as it'll probably go, but there's a positivity on the horizon.
Sure. I'll throw one to you. Do you believe the house you live in is an asset?
Yeah, I do, but I rent it.
Sure.
And I wish I owned it.
But why? But you see, if you did the sums, I pretty much guarantee you'll find out that it's not an asset, and it's the argument I have often. While I get the idea that the house you benefit from living in it, the cost of running a house in South Africa is high. The FNB surveys, pick one, any of these home price surveys, they show that we don't have the steep growth curve anymore in terms of how quickly property is going. And the house you live in, once you've added in inflation and the maintenance costs and the financing costs over your 20 years, it very quickly becomes, it's not an asset, it becomes a liability.
What's the difference though between sectional title and freehold? Because if you are talking about costs, those costs can be taken away if you don't have to look at the upkeep of the swimming pool in the complex, painting, etc., and security as well.
Sure, there I agree with you, and I think that Jonathan's probably got insight to it as well. But the idea that it's trying to maintain these properties, you still got the risk of the body corporate. I mean, if you are as weak as the weakest person is within the body corporate.
Yeah.
And that would worry me. That would be something I would worry about, because then you're kind of looking at the guy next to you and saying, is he actually pulling his weight?
No, you do need a good, well-managed body corporate.
So is there still money to be made by buying property right now? I mean, if you are looking to buy an actual property, where should you be buying?
I would look at a couple of sectors. I'd first of all look for something which is secure, and something where your maintenance isn't too high. You could buy a rambling acre property, but you've then got the upkeep of maintenance, cutting the lawns, those sorts of things. So what your typical investor will go for is something that exists in a complex, like you mentioned earlier, sectional title, where there's a levy which contributes to all of those services, the lawns, all of those sorts of things. But excuse me, from an area point of view, look at Melrose Arch. There's a fantastic opportunity in Melrose Arch. The inner CBD, which I think has been forgotten for many years, is alive and thriving. There's a huge amount of renovation, new buildings being converted into...
There's been alive and thriving for some time now, hasn't it?
Absolutely.
Or is it more so than it has in the past?
More so than it has in the past. I think the perception of the CBD has always been it's the CBD. But my advice would be to drive into the CBD, have a look around. There's a lot going on. There's some very good investments. And it's becoming a very, very interesting melting pot.
Keillen, tell us about how we should invest in the listed property space, because that's what Mark is leaning towards and buys with. So where's the opportunity right now? Which are the top stocks there?
In the retail space, we like high prop investments. They own the big and dominant retail, like Canal Walk, the Glen. And in the office space, I'll go for Cycom Property Fund.
But you don't like office space though, because of the fact that there's so many vacancies.
That's right, yeah. But relatively speaking, probably bigger corporate tenanted offices is a lot better. And then
better quality asset, tenants rather.
Yes, and then non-metropolitan retail will love companies like Resilient and Fortress. They dominate that space. They're in the low income to middle income areas, and those markets work quite well.
Yeah, I mean, one of the questions I have, though, I mean, there's a lot of new property listings coming to the market. Should that be something we should be worried about? Because it almost gets the sense, every time you see a sector booming, there's invariably a bust that comes after it.
That's right.
But I mean, if you look at the portfolios as a layman, you look at the portfolios, you think they look all right, they're cash generative. None of them are hugely indebted, from what I can, from the ones that you can, from what you can see. Should we be worried about all these new listings that are coming in?
Not really. Actually, we look at we select the companies and giving us more choice, size, and liquidity for the sector. The sector has been growing over the last 2 to 3 years. So welcome new listings, provided they offer the good quality, good management as well, and they diversify the sector. But we're selective on that.
Now, a lot of the property companies are being reclassified as REITs.
Yes.
Tell us about that and why it's favourable, and is it favourable to shareholders?
Sure, it is. So in simple terms, REITs, which is a REIT, Real Estate Investment Trust, it's a global property legislation. So what it does, just eliminates tax completely from the books of these property companies. So there's no deferred tax, there's no capital gains tax. So you're getting a nice, clean structure that investors understand. And actually enhances deals and mergers and acquisitions. The foreign company is holding back, but now it's a lot better. And we're the 8th largest REIT market in the world. So foreigners, if they look to diversify, South Africa comes as a good choice as well.